Today is Monday, July 24th, and this is the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services, Archer Financial Services, or ADM. Today's guests are Mark Soderberg, ADMIS Senior Ag Analyst, and Steve Platt, Archer Financial Services Senior Account Executive and Energy Analyst. Starting with the grain markets this morning, Mark, Russia has been bombing Ukraine's terminals along the Danube River. What impact will this have on the agricultural markets?
Potentially very significant. With the recent collapse of the Black Sea Grain Initiative, Ukraine's ag exports have been limited to either rail and trucking transport through neighboring European countries or along the Danube River along its border with Romania. Volume of agricultural exports of corn, wheat, soybean oil, it's already been forecast to drop to 35 million metric tons for the 23-24 marketing year, and that's down 30% from the last two marketing years. So it's believed roughly 24 million metric tons of these ag goods could flow through the Danube River, with the balance being trucked through neighboring countries. So with the bombardment now, it could the extent of damage right now is unknown, but this could possibly restrict the exports just through these trucking sources, which would put additional strain on other exporting countries like the U.S. to absorb this lost supply. So at this point, it's unclear the extent of the damage. However, what is clear is that Russia is trying to cut off Ukraine's ability to export ag goods to the rest of the world, and a big reason why corn, wheat, and vegetable oil prices are sharply higher this morning.
Mark, let's talk about weather. What's the near-term forecast for the grain-growing regions here in the U.S.?
Well, it's pretty much as advertised as from late last week. Very hot and for the most part dry through much of the nation's midsection this week. High temperatures do not appear to be as extreme as some models were leaning towards about the middle part of last week. However, daily high temperatures are expected to reach the upper 90s, with even a few days of 100-plus degree temperatures as far north as South Dakota and central parts of Iowa. So this is very stressful for U.S. corn and soybean crops, and also for our country's livestock. So, but by late this weekend into the early part of next week, it does appear that the high pressure ridge is going to get compressed a little bit and move off to the west, which would bring better prospects for organized rain across the central parts of the U.S. midsection. Both the National Weather Service 6 to 10 and 8 to 14 day forecasts do offer up normal to above normal temperatures, but better chances for precipitation.
Briefly, Mark, what's your expectations for this afternoon's crop progress and condition reports?
Most seem to be leaning towards steady to slightly improved conditions. I'm looking at the 7-day rainfall maps. I'm leaning towards some slight deterioration. We've had very little rain through much of Iowa this past week, through central Illinois as well, and up into the Dakotas. So temperatures, while they weren't extreme last week, so I don't think you're going to see big drops. I'm looking for about a 1 to 2% drop in corn and soybeans, more of a 2 to 4% drop in the spring wheat ratings, and winter wheat harvest is likely reached at 66 to 68% level, and that's still behind the historical average of 77%.
Thanks, Mark. And Steve, thank you for joining us this morning. OPEC production cuts were extended in April, and Saudi Arabia also has made additional voluntary production cuts. Why haven't values rallied more than they have?
Well, we certainly are seeing some strength here the past few days. And I think a biggest reason has been the uncertain demand outlook, particularly in China. That has certainly led to some revisions downward by some of the major forecasting areas. The IEA, International Energy Agency, did revise downward their forecast for the first time this year in their previous report by about 0.2. But there's a lot of uncertainty in China that has precipitated some caution on their part. And some people have even suggested that the Saudis took this action knowing that the demand side could be worse than expected. I think at this juncture, with the development in interest rates, that has eased some of that pressure and led to the recent recovery. We still have to watch the Russians in terms of their level of availability, and also even Iran, where availability has also increased. But generally, we're getting back up to the levels we reached when the Saudis first put this out. Whether we can go higher will be contingent upon the stock levels as we move into the second half and through the second half of this year with respect to declines.
And Steve, refining margins have been strengthening since May, with the gasoline crack moving out from the near $25 a barrel in May to $38 a barrel currently. What are the prospects for further gains?
You can probably add a buck or two to those today.
Wow.
But right now, the market is certainly at that juncture where they're watching the inventory levels for both gasoline and distillate. At this juncture, we're at the lower end of the 5-year ranges for those stocks, despite some of the recovery in terms of heating oil or diesel now. The other is gasoline. We're actually below those ranges. So stocks are still rather tight. Refining capacity is somewhat expanding, but not quick enough to maybe account for potential growth in the economy. So there's still probably some upside here. I don't think it will get to the point where we were last year, where we saw gasoline get up to 60. It might come close. The heating oil got up to as much as $80 last year. And at this juncture, I doubt that will be the case, given the softness in manufacturing, not only in the U.S., but also China as well.
Lastly, Steve, natural gas storage levels in Europe are reportedly 90% full. What impact will this have on natural gas exports from the U.S.?
Well, there is some talk, and right now, Europe is looking toward getting to that 90% level. Germany has actually reached some of their targets here 2 months early in terms of their storage levels. So there has been some concern that some contracts might be canceled. But we have seen some pretty active demand out of China here for LNG from the U.S. And certainly we'll have to watch how the hurricane season progresses here over the next few months. That can have actually an adverse impact on our export levels if it takes out some of the processing units for LNG.
Thank you both. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as views or opinions of ADM Investor Services, Archer Financial Services, or ADM. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.